Hello, everybody. I hope that everyone can hear me a-okay. Welcome to today's information webinar on the Collective by Exceed Capital, a new diversified fund opportunity by Exceed Capital. Today, just a little bit of housekeeping. We will be using the Q&A function to facilitate two-way communication. So please, if you have any questions throughout the session, please pop them in the Q&A chat. The normal chat function has been disabled. Pop them in there and we will either answer them throughout the course if they're relevant. Otherwise, we have a live Q&A session at the end of today's webinar. So we will kick things off. Today, you will be hearing from Vaughan, our Managing Director and co-founder of Exceed Capital. We will also be having Adam Wilmore join us. He's our Transactions Manager. You'll have myself here today as the MC. I'm the General Manager, Eliza Bennett, here at Exceed. We do have apologies from Justin Clark, our other co-founder and director, who was unable to make it today. Just a little overview. So we're going to do a bit of a quick intro. We'll go through who Exceed Capital is and what we do. Then we'll get into what the collective is. We'll take you through the initial seed assets and the properties that we're purchasing, how to invest, and then, as I mentioned, we'll have the live Q&A at the end of today's session. So to kick things off, who is Exceed Capital? Exceed is an industry-leading, values-driven investment manager. We're proudly based in Brisbane, Queensland, and we're dedicated to collective wealth creation. Exceed Capital was founded by Vaughan and Justin Clark in 2016, and we have a growing portfolio of assets across Australia. We see our investors as partners. Your success is our success. And in doing that, we have a growing team with a vast range of skills and expertise that we have in-house. It's ranging from funds management, property management, as well as finance, our property team, in-house operations, legal, and leasing. So we have a multifaceted team here to support any and every aspect. So about us, we're growing very fast. We're soon to have over $400 million in assets under management across 15 assets. These are predominantly on the eastern seaboard of Australia, ranging as far north as Townsville and all the way down to New South Wales. And our latest investment that we closed in January saw us spread out to Adelaide CBD. We're heading into our 10th year of operations. And in doing so, we've got an average return across our funds of 8% as a cash return and an internal tracking IRR of 17%, which is a pretty great result across the board. As I mentioned, we are values driven, and this has been the foundation of our success. So I've been with Exceed for about 9 months now, and this is what Vaughan and Justin had created, and we were able to put it into words to align with the great work that they had already been doing and building with their investors. So to start with it, alignment, this is reflected across many facets from our team, friends and family co-investing in every trust, but also from the fee structure. Our fees are aligned where most fund managers will charge fees on assets under management. We provide our fees based on the gross income brought in. So if our investors aren't making money, we're not making money either. We provide a disciplined approach with integrity is very vital for us. We're disciplined in everything that we do, whether it's through our audits, our governance, and at the end of the day, we're committed to doing what is right. We're very transparent with our communication. We're clear and honest, and we don't hide away from those difficult conversations. Of course, things happen. We don't want them to happen, but things happen, but we'll put our hand up and we will communicate that with our investors and we'll tell them what the action plan is to move forwards. Stewardship, we choose very particularly the assets that we're going to invest in. We make good decisions at the start, but then we make sure that we look after them. We provide proactive asset management to drive performance and maintain occupancy, as well as strengthen those relationships. And then we also strengthen and nurture those relationships with our investors and other business partners. And at the end of the day, we strive for excellence in everything that we do, whether that's through technology and systems improvements or just making sure that we provide the very best customer service and investor relations service every single day. So now we're going to get into things, and we're going to tell you all about the collective and why Exceed Capital has created a diversified fund.
Exceed Capital is really excited to create this new product, which will be a different offering to our investors. So it is a diversified, open-ended property trust, which will allow investors to be able to invest at any point in time, and it allows them to provide access to diversification across a well-diversified portfolio of property assets. So, for example, some of those property assets will be owning direct property in office, retail, large format retail, medical, etc. And that will be around counter-cyclical buying. So finding buying opportunities, we're able to get great value for our investors. And then also investing in some of Exceed Capital's other own unlisted managed investment schemes, so access to different product there, and as well as, for a smaller extent, listed AREITs or Australian Real Estate Investment Trusts, and a bit of cash and interest-bearing securities, purely more to manage liquidity and also flexibility around acquisitions. This will provide investors with improved buying power as well, as markets tend to become more competitive. A lot of the time when it comes to buying, the terms around buying are more competitive as well. We're in a situation like this, with a trust like this, it allows us to accumulate some investors' money, park it against some of those, let's say, more liquid assets, or alternatively against gearing in our direct property assets. And then when we're ready to purchase an asset, we're able to be more competitive around our buying, which benefits our investors. A big benefit to investors is around the diversification, meaning that we're providing investors with a professionally managed, diversified portfolio across different aspects of property. It also will be providing investors with a targeted return of between 7 and 8% per annum, and that will be a cash return paid to investors on a monthly basis. There will also be the benefits of tax-deferred benefits to investors as well. With regards to those assets that we put into a trust, each one of those assets needs to be able to stand by itself and deliver a 8% return in our financial modelling before we would consider putting that into the trust. So it's important that we're putting in really good quality assets into that trust, rather than just trying to build up a trust with multiple different assets and not delivering the return expectations to our investors. We'll also allow investors to be able to gain further access to our exposure of countercyclical buying. And what this is all about is, when a lot of the larger companies, in particular the listed companies, are selling these assets, we're actually able to have funding there and support by investors to be able to look to buy those assets. And that's where you often get opportunities to buy these assets when the long-term average pricing is a lot higher, and we're able to buy at a lot better prices, providing better returns to our investors and better capital upside on those assets. We're also going to be offering investors a managed liquidity ability, which means that on a 6-monthly basis, investors will have an opportunity to be able to exit this trust at the current unit price. That liquidity will be available after a period of 2 years.
So Vaughan, do you think you could just go through and re-summarise the key highlights of the collective for us, please?
Morning, everybody. Thank you very much, first of all, for taking the time out this morning to be with us to discuss this opportunity. It's a fantastic, exciting opportunity that we're all excited here at Exceed Capital to be able to release to our investors. It is slightly different to our typical product offering, where it would normally be in a single trust. and a single asset in each trust. This will be the first time which we're going to be opening a open-ended fund, which will also have a liquidity option there as well. So it's a new product, and we so far it's been very well received. The key highlights are, as sort of mentioned in the video, there's going to be an 7 to 8% cash return paid monthly. And all of our assets that we're looking to buy will be looking to target that sort of 8% return on that. But as the trust grows, it will be ideally 8% and above, where we may have a little bit of volatility between that 7 and 8% in the early days of the fund. We're also going to be a truly diversified portfolio, so that's going to be across 3 different regions, being asset classes, property sectors, and locations. Exceed Capital has got a very strong track record, and Eliza mentioned we are aligned with our investors, how we undertake everything with regards to our fee structures, to also investing with our investors as well in every product. That flows through in the results, where across our entire portfolio we have less than 1.8% vacancy across all tenants, which is very low for the industry standard of around that 6 to 8%. We've got a very strong track record of over 9 years, delivering great returns over 8%, and typical IRR tracking around that 17 to 18% per annum. So yes, another exciting product, and it will have all the strong fundamentals and structure of what we are known for with our investors.
Thanks, Vaughan. So when you say this is truly diversified, what does that mean? So you've said property sector, location. Can you go into a little bit more detail about what that actually means?
Sure. So I guess it's across 3 different areas. First of all, asset classes in the way with regards to property. So it will invest in direct property itself. So we'll have a couple of 2 initial assets that we'll be purchasing, one in Bundaberg and one in Newcastle. I'll let Adam touch on to that with more detail shortly. It will also have the ability to invest in our new closed-ended investment scheme. So our typical assets that we have created in the past being our single asset closed-ended trusts. This trust will also have the ability to invest in new future products of that style as well, because Exceed Capital will continue to create those products going forward as well. It will also be able to invest into A-REITs and cash to a smaller portion, and other property securities, with regards to more around the providing a buffer for liquidity there and redemption. So we're always planning on having a minimum of 5% allocated to those more liquid assets. Then we've got the property subsectors will be another tier of diversification, and that is instead of just having a open-ended trust which is purely office or purely industrial like a lot of people, this will be able to invest across all sub-asset classes of property, being industrial, office, retail, large format retail, hotel, allied health, etc. And so that will provide true diversification, and will also allow us to be able to continue with our counter-cyclical buying, which means that when we see opportunities to buy below replacement cost and different things like that, or can take advantage of a dip in a market, being truly diversified like that allows us to continue that great buying structure that we are known for. Then we've got locations. This trust will be investing across assets across Australia, and that will be both capital cities and regional areas.
Perfect. Truly diversified indeed. So I guess we'll now hand over to Adam, who'll talk us through those first initial direct properties that we're going to be purchasing.
Yeah, thanks, Eliza. So the first 2 properties we are buying are in One's in Bundaberg in Queensland, the other one's in Newcastle in New South Wales. So very different locations, but the properties are actually quite similar in a lot of aspects. They're both backed by secure long-term government tenants, and both buildings were purpose-built for these government tenants. The first one I'll talk about is in Bundaberg. It's anchored by Queensland Health. Like I mentioned, it was purpose-built for Queensland Health, who initially occupied just the top floor of the building. Over the years, they've expanded into some other space, and now they occupy 86% of the property. They've been a long-term tenant. Like I mentioned, they've been in there since it's been built. They provide clinical services, so not services that typically happen at a hospital. They're more off-site clinical healthcare services. We're buying it, both properties we're buying well below replacement costs. This one in Bundaberg is in a very prominent location opposite the Mater Hospital and the main current health precinct of the town. It's got plenty of customer parking. It's got two other tenants in there, an eye specialist and a cafe, both good, strong, long-term occupants there. The second asset is in Newcastle. Again, it was purpose-built for a different government tenant. This time is a family and communities child safety style tenant. They service this immediate region. They've got very specific requirements around security and safety for people who come to the building. They don't share well with others, so they need to be in a standalone building. Like I said, they've been in this building for a long time. They've still got a 3-year option remaining. It's got the 5.5-star neighbours that government need. It suits their needs perfectly. And again, we're buying it on a similar rate per metre, the high 4,000s a metre, which is good buying. And yeah, it's just a great opportunity. Both properties are great opportunities, and they're very well aligned to pair together.
Wonderful, really good assets indeed. So we've had a question come through. You did touch on it for the Newcastle one, but what are the lease opportunities, or the lease options, I should say, on both assets?
So Bundaberg, the major tenant in there, Queensland Health, or the Wide Bay Health Service. They've been in there such a long time on long-term leases. They're in their last 5-year option term, so they've just started a 5-year option there, so they've got 5 years to go. The two other tenants have 3-year options remaining. The Newcastle office building, we're buying that very well because it's got a short WALE. So the lease term currently expires in 2027. Like I said, for all the reasons I outlined before, we're very comfortable that the tenant won't be going anywhere. So they've got a 3-year option. Being government, they usually wait till the very last minute to make a decision, but that usually works in the landlord's favour as well. So yeah, they've got a 3-year option remaining in Newcastle.
Great. So our investors should not be worried that there's just a 1.8-year WALE on that Newcastle office building.
The 1.8-year WALE is the reason we're buying it very well. It was a calculated assessment of the property. If we thought there was a strong chance the tenant was leaving, we wouldn't be buying it. So the 1.8-year WALE, but some people would see that as a risk. We saw that as an opportunity to buy the property very well. If it was a long WALE with a government tenant, this would be a 6% or 6.5% asset, where we're buying this one in the 8%. So.
Wonderful. Great opportunity indeed. So we will now move on and have Vaughan talk us through the initial units and what the key dates look like.
Sure. So originally under the trust, we will have what's called initial units. So even though the trust is going to continue to be open forever for investment, we will initially be raising $13.5 million, and that will be used to settle the 2 initial properties that Adam has just talked about. With regards to those 2 key dates there, I guess, first of all, we're looking to raise that $13.5 million by before the end of July. Originally in the IM it mentioned around the 11th of July. That has been pushed back by just over a week because we had to extend due diligence for that period because the vendor was still to supply us with further information. That's all been completed now and we're happy with that, but it pushed back our dates by just over a week. So what will happen then is the properties will settle at the end of August and early September. And the big thing which we, as part of that $13.5 million of initial capital raise, for us, we also have to be what's called widely held. And that's where it talks about the 50 investors there. So a key thing for us is before we issue our first lot of initial units, we need to make sure that we have over 50 investors. At the moment, it has been strongly received, which is fantastic, and we're just over halfway already with both investors and capital, which is great. But that is capital is not going to be an issue. I can assure you that. The big thing is for us is just making sure that we get 50 investors in the trust before that date. Reason for it, without going into too much detail, it's stamp duty related with that. So we just don't want to obviously be paying any additional stamp duty penalties or anything like that if we had less than 50 investors and settling more than one asset. Then we've also got a point there on the bottom there with regards to an upcoming investment as well. This is something which we will be looking, this trust will be looking to invest in later on as well. And that's a fringe Brisbane asset, an office building asset that includes two properties. One is a data centre and one is an office building with a ASX listed tenant in the top and some smaller tenants down below. Great property, great mix of tenants. We'll be delivering some strong returns as well. But most importantly, that will give a good diversification in the early days of that trust across 4 assets, which will be our Bundaberg property, which is medical. It will be our Newcastle office building with a government tenant. So it will have strong security of government tenants at an early stage. It will have the ability with the data centre as well, and an office building as well, like I mentioned, with listed tenants, which is coming sort of probably about a month down the track behind this product.
So truly diversified from the very beginning. That's really great for investors. So what's going to happen if we raise more than the initial property amount of $13.5 million?
What will happen there is let's just say if we raised $15 million under the initial unit, so it doesn't just cut off at 13.5 million, it will always be open for new money. It's just that's the minimum amount we need to raise from day one. So if we raised $15 million, for example, that additional money would typically be putting that against the mortgage facility. So therefore, we've got that there ready in a liquid nature, which will be able to allow us to invest in this fringe Brisbane asset that we're talking about coming down the line in about a month's time.
Perfect. And now when we're talking about units and we're talking about investment, the thing that investors obviously want to know the most is when will the first distribution be paid?
Good question. The first distribution, so property settlement will be, like I mentioned before, at the end of August, early September. The first lot of income will be the September rent, and that will be paid at the end of October. So the first distribution will be typically around that 26th or 28th of October, depending on where that falls with weekdays. And then from there on will be monthly after that.
Perfect. Don't have to wait too long at all. So now I'm sure you're all wondering, what are the next steps and how can you be involved with the collective? So I'm going to just take you through quickly how to invest. So firstly, we want you to get in touch. Reach out to us if you've got any questions following today's session, or if you don't already have a copy of the IM, please reach out. Once you have a copy of the IM, we want you to read through it. Make sure you understand it, understand the investment, and again, reach out to us if you've got any questions whatsoever. At the back of the IM, there's a paper copy of the application form. Alternatively, you can head over to the investor portal. All the information is in that information memorandum. You can head over to the investor portal, fill in an application online, and then any new investors will need to provide appropriate documentation. And this is different by investment type. So read through the IM and make sure that you have the appropriate documents. With your application, we'll need a 10% deposit submitted at the same time to secure that allocation for you. So whilst it is an open-ended fund and the initial units will be closing in a couple of weeks, we want you to get involved and have a chance to be part of that initial investment holding and be part of the collective. So yeah, we don't want you to miss out. Reach out if you've got any questions or you would like a copy of the IM. So we're going to start heading into this live Q&A piece. So we've had a couple of questions come through that chat function. Please, if you've been sitting there and you've got a question on your mind, someone else probably has the same question. So please don't hesitate, pop it in the chat. You can do it anonymously too if you're worried about that. Pop it in. We want to make sure that you have all your questions answered. So Vaughan, I think this one is going to come over to you. What is the benefit of having an open-ended fund? Exceed has only done close-ended up until now. So why are we opening an open-ended?
Sure. Yeah, good question. Look, it comes down to a couple of different things. First of all, there's obviously plenty of benefits there for investors, in particular around that diversification, especially investors who may not have the portfolio to be able to invest in every new asset or new trust that we launch to get true diversification, where this will provide that diversification across both our portfolio of future assets as well as other areas like location and different things like that, as mentioned earlier. Another area is that it's going to be open all the time. So I often get investors contacting me, in particular before 30th of June, when they've been chatting with their accountant or advisor and they need to allocate some money or in one of their entities, and often we don't have a product open because we may only launch a new product once or twice a year or something like that, where this product will be always open for investment, and it will be able to help those investors accommodate those investors.
Perfect. It sounds like Exceed is diversifying their own portfolio too. This is the first time that Exceed has offered a managed liquidity option. Why this time and how is that going to work?
The managed liquidity option is after an investment period of 2 years. So investors need to be prepared to, whenever they invest into this trust, invest for a minimum of 2 years. And then after that, we will be providing a 6-month liquidity option or redemption facility, so to speak. That will be offered in March and September. So biannually, and what that will be is we're calling it a managed liquidity. Why? Because there'll be some restrictions around it. So it will be capped for not across the entire portfolio, so the entire investment. It will be capped at 5% per annum of equity issued, and also initially $5 million. The $5 million cap may revise that as the trust gets larger and larger. But what we're wanting to do is make sure that there is, let's just say there's liquidity for those people who need liquidity, and people have got all different reasons for that. But we don't want it to be like a listed company where there's a massive run on liquidity because of speculation and other things, which means that then we're having to sell assets below prices, below their book value sometimes, or in distressed scenarios where it impacts all investors. because that's where we typically find buying opportunity from those listed companies. So we definitely don't want to fall in that same scheme as them.
Perfect. Definitely putting a bit of risk and reward in there. Speaking of risk, how is the fund being structured? Is there any cross collateralization of debt with having the multiple properties?
Yes, that is another good question. At a high level, just to me explain for those who may not be aware on our webinar, cross-collateralization, what does that mean? It basically means that we want to make sure that every asset that we buy within the collective, it has its own debt facility, and its own debt facility is only tied to that asset. So for security purposes, take for example our Newcastle and Bundaberg. Each of those assets will be tendered out to the banks independently to make sure we're getting the best rates of interest on those mortgages for the lowest rates. And those two properties will be independent. So the loan on Bundaberg will only be secured by Bundaberg, and the loan on the Newcastle will only be secured on the Newcastle asset. So there will be no security which goes past those individual assets.
Perfect. Definitely secure and mitigating those risks there. So this one's for you, Adam. And these are some great questions, so please keep them coming through. Is there any risk of somebody developing a new building and trying to take our tenants away from us?
I think that's an extremely low risk in the current environment. I think everybody would be aware that construction costs right now are so high, no matter what you're trying to build, that for these tenants that we have in our assets, the rents they're paying are in the high $400 a square metre gross. For someone to be able to build a new development and have that stack up financially, the rents would have to be at least double than what they're currently paying. I guess the Newcastle one with the short WALE that some people may think is risky, with the shorter lease expiry. The tenant services that area and needs to stay in that area. If there's a new development underway, we'd know about it. It'd be under construction. But like I said, the new developments don't stack up. Rents need to be twice as high. And even though governments can make some bad decisions, if they're in a building that suits their exact requirements and they're paying half the rent they are for a new development and there's no reason to leave, then they're not going to leave. So,
yeah, it'd be silly to leave by the sounds of it.
that's right.
So Vaughan, as investors continue to invest past the initial units, will additional funds dilute the initial unit holders' returns?
Simple answer to that is no. There may be a tiny bit of fluctuation there as the fund is in its smaller stages, but that will be between that 7 and 8%. That's why we've got that range at the early days. The reason for that is because anything over that $13.5 million of the initial units, or even going down the line as we obtain more equity and in between buying assets, that will be parked in across the mortgage as like an offset account, so to speak, or other liquid securities, which do provide a slightly lower return than the 8% of those initial assets. So it may in the early days bounce around a little bit between that 7 and 8%, but the more assets that we buy, the larger the fund gets, the more that will provide security around that 8% and above.
Perfect. I've had another one come through here and it's got almost two parts to it, so I might split this. We'll start with Adam's side. Are there any areas that we're looking at currently, any markets that are looking promising that we want to invest in?
We're looking at assets in a lot of different markets, and that's part of the whole diversification strategy. But probably I'm still finding the most opportunity right now in office assets. That's the most counter-cyclical market right now is office, and even there's a bit more healthcare assets coming to the market as well. So that's probably the main focus. There is a few retail assets that have come up, but we're looking into all different markets, interstate, close to home. But like Vaughan mentioned earlier, the next one we have in the pipeline is a Brisbane Fringe office building. So that's the one to stay tuned for.
Right. I guess the benefit of diversification means we can look anywhere and at anything. So the second part then, Vaughan, is how will new properties entering the trust be screened?
Yes, so new properties which we consider in the collective, first of all, there'll be an investment committee, which includes myself, Justin Clark, and Adam Wilmore. That investment committee will look at any new investments that are considered for the collective and weigh up the risk and the return benefits around that. It will also, I guess, sorry, just on that. So a perfect example, I guess, is the focus is very much around strong and stable income for this the collective, as well as capital upside. So one of our previous assets, our last asset that we bought, which was a fantastic asset in Adelaide, however, that asset is more focused around growth and capital upside later on. So it was 50% vacant. It needed some lobby foyer works there, some spec fit outs to be undertaken. So the rents and income of that asset will slowly ramp up, which will mean the distributions will slowly ramp up. So it's a bit more of a capital play on that one. That one, for example, wouldn't be suitable for this trust because we'd be looking for initially an 8% or very close to off each asset from day one, which we put into this trust. Would also be looking under that investment committee to make sure that we are buying pretty much all the time or definitely where possible below replacement cost. And that's following our counter-cyclical approach of buying. We always have the saying here that we make our money on the way in and we crystallize it on the way out. So what does that mean in simple terms? It's all about buying well, making sure that when we're buying properties, we've got risk buffers there. Things are sometimes out of our control and things do change, where if you've got risk buffers and you've bought well, you've got the ability to mitigate some of those issues if things do pop up.
Perfect. Another one that's come through there is in regards to our loan facilities. So we use debt facilities for our assets. Do you get only an interest-only loan, or are we paying down a principal and interest as we go? Are you able to just clarify that one for them?
Sure. It is an interest-only loan that we take out. However, we do have I guess you could say, a redraw or an offset style facility, which means that we are able to park any surplus money against the mortgage, which has a similar effect somewhat to a paying down some principal or offsetting that. What is that? What we do that on a regular basis, even with our existing assets and trust that we have. We always raise some extra money up front for ongoing capital expenditure and leasing funds, and that will be no different with the collective as well. And that money we park against the mortgage as well, along with rent, which is received from our tenants in between when we're paying our distributions. So we're always about making sure that every dollar for investors is working for them, rather than having lazy money sitting there not earning any return.
Yes, definitely. Great question though. So I've got two more by the looks of it. So if anyone's got any more questions to pop through, please pop them through. We want to make sure we've got everything answered for you. You mentioned that to be widely held that we need 50 investors, and that's going to be not a struggle for us, but it's going to be harder than getting the initial funds. So investors if they had multiple entities, would it help if they invested through them?
Absolutely, that would be appreciated. Look, as we mentioned earlier, it's around the stamp duty side of things, the 50 or more investors to be widely held. Across our larger trusts, we always typically have 50 or more investors. The only reason why with this one we're focusing so much on the 50 investors is they're two smaller assets that we're buying, which we just need to, like I say, we're not worried. The $13.5 million, we're easily going to get there on that. Is making sure that we've got a good spread of investors from day one.
Perfect. And with that, can investors top up their investment, or do they need to go back and invest 100,000 each time?
No, so the minimum investment under the trust is $100,000. As mentioned, happy to have that spread over a couple of entities. That would definitely help us out. Then also with future investments as well, people can top up their investment at any point in time. Happy to reduce that to investors' needs. It's sort of, as long as it's not like $5,000, for example, but happy to do smaller sums after the invested the $100,000 of initial.
Perfect. And finally, this one comes from me. How did you come up with the name The Collective?
Yeah, that's the collective. We were, being honest, we were bouncing around a few different names for this trust at first. We didn't want to just call it the same as most people do, and that's a diversified property fund or a XYZ property fund. For us, this is about the best of the best. So taking our best structures and strategies, putting in the best assets around the collective, and also being the best in the industry for this product. So we have a bit of a slogan here, collective wealth creation, which has always been with us when we first started Exceed Capital. And that is about collectively as a group with our investors, with our service providers, with everybody that we interact with, collectively working together to grow wealth. And that means that not necessarily where people have got different skill sets, we're not trying to bring all of those in-house as an employee, understanding that, okay, people have got those strengths, so let's use those people to undertake different things with us to get the best for our investors. But a lot of those investors, a lot of those service providers and people like that have also become investors, which is fantastic. So it just brings that collective group of what we call investment partners together. So we thought, why not call this the collective, which ties in with all of those.
How good. The collective indeed. So thank you all again for attending. We do have an experienced, trusted and proven team behind us. They're highly skilled across all functions. We're here to help. We want to answer any questions you may have and provide support throughout the application process and beyond through your time with us. So please don't hesitate to reach out if we've missed anything today, or you've got any lingering questions, or if you'd like a copy of the IM, please get in touch with us, email us, phone us. We want to hear from you. And yeah, we hope you have a great day and hope to see you as part of the collective by Exceed Capital.
And please, I can't enforce enough. We pride ourselves as a company on communication and being approachable. If anybody has got any questions, they're welcome to contact me directly, or anyone in our office will help if you contact the office number. So please, we encourage that. We love to sit down and meet face to face with our investors, or alternatively catch up over a phone if possible. Thank you very much.
Thanks.